All right, good morning, everybody. All right. Eric Starnes from Insurance Warehouse. I've probably met a lot of you before. Our agency is a local independent agency here in Golden Valley. We have now up to 40 staff. 32 of them specialize in the HOA space. So this is all our agency does. We spend a ton of time in it. We're now the largest insurer of townhomes and condos in Minnesota. We've got just over 1,500 associations, which is 80-some thousand units. So it keeps our team very busy, as I'm sure you can imagine, with how fun the industry's been over the last few years. Just a show of hands, who's heard me speak before? Have you ever heard me speak and deliver any positive news? All right, so today's your day. We finally have some good news for the first time in a very long time. To start out, if you've seen me speak before, you've probably seen this graphic multiple times. So this is obviously a map of the United States, but this is the 25 different billion-dollar catastrophic events that happened in 2023. At that time, the 25 different events was the most that our country has ever seen. A lot of that has to do just simply with pricing these days. To hit $1 billion, a lot easier than it was 20 years ago, but it set the record at 25 separate events in 2023. We followed that up in 2024 with 27 different billion-dollar events. And so, as insurance is a shared risk pool, whatever happens across the country is going to affect Minnesota or anywhere else because all of the risk is pooled together. And so having two back-to-back unprofitable years across the country negatively impacts what we see in Minnesota. In 2025, so far this year, and we're not expecting hopefully anything catastrophic in the next 2 weeks, but there's only been 14 events so far this year. California wildfires started off the year in January. That ended up being over $50 billion in total damages. And if you look at this next graph here, the purple line is 2025. So significantly less than what we've seen in years past, and the total is 101 billion. So if you take out the 50 plus billion from California, 2025 is stacking up to be one of the most profitable years insurance companies have seen in a very long time. The good news for a lot of insurance companies is they weren't in California. So the companies that were not in California are looking at one of the best years that they've had the insurance space in a very long time. The ones that were in California are suffering significant losses, and you'll most likely see that impacted across the board for them, but most carriers weren't in California. So that kind of is the tip of the iceberg on how we're starting to see some positive trends, is that the industry actually had a profitable year for the first time in a long time. But that's not to say that 2025 didn't start off a little tumultuous. So 2025, we were off to a bad start. If you've seen me present before, you're well aware of some of these changes. But on January 1st of this year, American Family announced that they were non-renewing all the rest of their HOAs. So they had spent the last few years essentially trying to get rid of their HOAs. They increased pricing, changed deductible, added exclusions that made most of their clients leave American Family and find a different carrier on their own accord. The few that remained, American Family said, we no longer want anything to do with this business, and as of January 1st announced that they were non-renewing the rest of their portfolio. So there's probably a few HOAs left in the last 2 weeks that still have American Family. Those will be the last few, and then American Family will have no associations left in Minnesota. About 10 years ago or so, they were the largest insurer of HOAs in Minnesota. I've heard up to 70% of the market share at one point. And so to go from 70% market share down to zero is obviously a significant change for a company like that. Country Financial, another smaller HOA carrier, also announced on January 1st that they were non-renewing all of their HOAs as well. And so although Country wasn't as big of a player as American Family, they focused on the smaller and older associations. So we've seen a lot of the smaller, older associations with Country Financial get non-renewed and see their insurance significantly increase when they're finding a new carrier. State Auto, which was one of our largest carriers, before they were acquired by Liberty Mutual, they had no restrictions on age and size. And so we wrote a lot of our larger, older associations with State Auto. Now that they were acquired by Liberty Mutual, it makes Liberty Mutual the largest independent insurance carrier in the country. However, state auto is no longer allowed to write HOAs any longer. So they all moved over to the Liberty platform. State auto is still renewing the current ones they have and grandfathering those in, but they are no longer taking any new business. The remaining carriers that were left essentially had a bit of a knee-jerk reaction. You started off the year with large announcements from American Family and then Country Financial, and the carriers kind of took a step back and thought, American Family has more data from a claim standpoint, from a billing standpoint, than anyone else in the industry. They were the largest insurer at one point. They now want nothing to do with associations, and so the carriers kind of thought, is there something we're missing out on? If they don't want it, why should we want it? And so carriers took a step back, started to readjust a lot of their underwriting guidelines, and really limited the type of HOAs that they were writing. So the age and the size of the associations have now become the two biggest hurdles when trying to find a carrier interested in quoting your association. And so to start with the age, originally when carriers kind of made their initial pullback from the market, 1990 was the cutoff. They said they don't want anything built prior to 1990. Well, then that went to 95, then it went to 2000. Now most of them are at 2005. There's a handful of carriers that won't write anything built older than 2010. And so what carriers did was they looked at their historical claims data and just simply found that older associations performed worse than newer associations. As the HVAC, the plumbing, the electrical becomes a little bit older, you start to have more claims. And so carriers essentially said, although they weren't massive claims like billion-dollar hail claims, you have a water heater go out and you got a $20,000 water claim. For carriers that weren't interested in writing a ton of HOAs, the older associations become something they easily eliminated from their portfolio that they were looking for. Then we're looking at the size of the association. So 5-10 years ago, the size of the association, the larger the association, it actually benefited the association. Carriers targeted the larger associations. It was larger premiums. They wanted to go after the big associations. We've insured Bailey's Arbor, which I believe is the largest HOA in Minnesota for the last, I think, 7 or 8 years. 7, 8 years ago, we used to have carriers banging down our door saying, can we quote Bailey's Arbor this year? We want a shot at Bailey's Arbor. We want to write this one because it's $290 million in size. Now it's the exact opposite. Carriers hang up on me very quickly when I call them about Bailey's Arbor. They want nothing to do with an association that large. Essentially, their fear is if one hailstorm goes through, a large association has a significantly larger potential payout than the smaller association. So again, when they reviewed their claims history over the last few years in Minnesota, their larger associations are the ones they paid out millions of dollars on hail claims for. And so carriers completely flipped their tune on association size. Now they want anything that's smaller. And so each carrier has their own definition of what they consider small, but currently anything over $30 million in building values is considered large for most carriers. Some will cut off at 25, others 20, 15, 10, depending on the carrier. Some can get really small on what they're actually looking for. So what they're looking for is newer and smaller associations. They want new associations spread out all across the metro or all across Minnesota. So when a hailstorm does go through and hit 1 or 2 suburbs, they've just got a small footprint there and they've got a ton of risk spread out all across the entire metro. So thankfully, we haven't had hail in Minnesota in the last 2 years. And as you saw from the graph, 2025 has been a profitable year across the country. So we're finally seeing some positive changes for the HOA industry. We did have a new carrier come into Minnesota. So this is the first new admitted or standard carrier that we've seen in Minnesota in a handful of years. And so the company's called Honeycomb. That's their marketing or branding name. The actual insurance company is called Trisura. They launched in Minnesota at the end of August. I just checked this morning, we've got 47 associations with them already. So from August till now, we already have 47 associations that have switched their insurance over to Trisura. They will write up to $25 million and they have no age restriction. So the age restriction has been the biggest thing. I think most of those 47 are older associations that didn't have a lot of options over the last few years. And then current carriers, we're starting to see loosen their guidelines. So after 2 profitable years in Minnesota, we're starting to see carriers realize that they can actually make money again in Minnesota now that wind hail deductibles are so high. So auto owners, which is one of our largest carriers, essentially took themselves out of the market for the last 2 years. they required a 10% wind hail deductible on any new associations that we're working on if they had asphalt shingles. 10% wind hail deductible is not compliant with Fannie, Freddie, and FHA, so it essentially made them not an option for associations. They just dropped that back down to 5%, which is compliant. So Auto Owners is now back in the mix for us, which is great news. Berkshire Home State, which is one of our more popular carriers for older associations, Trisura is a huge competition piece for them. It's going after the older, smaller stuff that is what Berkshire was writing. Berkshire all of a sudden saw a ton of competition. They dropped their rates 20% starting on January 1st. Hallmark or HDI Global just increased their maximum TIV. They were at 14 million. They bumped that up to 20 million. Badger Mutual, a small mutual company based out of Wisconsin, increased their maximum from 7 million to 15 million.
What's
so this
TIV?
Sorry, total insured value is TIV. So how much your buildings are insured for. And so this is all changes that just happened in the last 2 or 3 months. We're expecting that starting in 2026, carriers will actually officially count all the money that they made in Minnesota, and then we're expecting in 2026, first quarter, to see some other positive changes from some of our other carriers. We also have plenty of non-standard carriers that have decided to target Minnesota as a place that they want to be competitive. So in 2025, so far this year, for new associations that we wrote through our agency, almost 80% of them went with non-admitted or non-standard carriers. The most common ones were Fortegra, MS Transverse, Lloyd's of London, and AmRisk. So the non-admitted versus admitted conversation is probably the most common question that gets brought up when I'm talking with property managers and with board members. We could probably spend a lot of time on this, but I'll go through it fairly quickly. We're going to have an open forum at the end where we can answer any questions. So if there are questions on this, we'll circle back at the end and we can answer those. But there's admitted carriers and non-admitted carriers. Admitted carriers are typically the companies that are writing personal lines. So the companies that you've heard of, you see commercials for. State Farm, American Family, Travelers, Hartford, Liberty Mutual, all those carriers that you're pretty familiar with. The Minnesota State Insurance Fund happens to, so they have a caveat that says they will pay up to $300,000 for a claim if the carrier ends up being solvent, becoming insolvent, and the carrier can't pay claims. However, there's a caveat that says if your deductible is over $300,000, you're actually not eligible for the Minnesota State Insurance Fund. So this fund is geared towards personal lines clients. Almost every HOA doesn't apply for the Minnesota State Insurance Fund simply because their wind hail deductible pushes them over that $300,000 limit. So for the admitted versus non-admitted conversation with associations, most of the time it doesn't really play into the conversation because the deductible is going to push you out of that $300,000 limit and you're actually not eligible for the fund. The thing that is important to remember when looking at non-admitted versus admitted is going to be the financial strength of that non-admitted carrier. For associations, you have to have an A-rated carrier or better if you're working with a non-admitted carrier. And so the insolvency issue shouldn't be a problem because you're working with an A-rated carrier. So sometimes the admitted versus non-admitted conversation gets blown out of proportion when really there's not a huge difference between the admitted and non-admitted carrier when it comes to HOAs. Now, the thing that you do need to worry about when working with non-admitted carriers is that they operate very differently than your standard admitted carriers do. And a lot of times that's not disclosed by the agent that you're working with, or it's something that the board is unaware of. So put together a few bullet points on the non-admitted carriers on why you use them and what you need to be aware of. So first and foremost, why we use non-admitted carriers is there haven't been competitive options, and they've been the most competitive over the last few years. If you've had multiple claims, if you've had any pending or open claims, if your association was built prior to 2000, if your building values are over 20 million, or if your roofs are over 15 years old, all things that the admitted carriers don't like, and so you might not have any options except for the non-admitted side. Now, when you move over to the non-admitted side, it works very differently than the admitted side, where when our agency is typically working with Travelers or Hartford or Liberty Mutual, those carriers put together a lovely package. Our agency doesn't have to do a lot. We type in the data and then it automatically puts together everything that the HOA would need. It includes your general liability. It puts your sewer and sump pump. It includes ordinance and law. So the agent can just kind of mindlessly go through, get a quote from Travelers, and they'll build out the package that the association should need. On the non-admitted side, it's not like that. It's more of an a la carte style policy. It's only the property. Typically, it doesn't come with any of the additional coverages that an HOA needs. A lot of times it's got exclusions or endorsements that are unfavorable for the HOA. And so the agent has to go through and build that property package together the way the HOA should have. Add those things like sewer and drain, remove exclusions like actual cash value or cosmetic damage. And so the agent has to spend a lot more time and have a lot more knowledge when working with the non-admitted side, because they actually have to build out that policy the way that you're supposed to. If they just take it from the non-admitted carrier like they're used to with Travelers or Liberty Mutual, that policy won't have all the things that the association's looking for. On top of that, there's a few other things that the non-admitted side does that are unique to their side of things, a lot of times not disclosed by the agent and catch the board off guard. So first and foremost, every non-admitted carrier requires payment in full. And so if your association either doesn't want to or doesn't have the funds to pay in full, you'll get caught off guard at the end when the agent either asks you for the full $100,000 or asks you to sign what's called a finance agreement. And so if you're not able to pay the full amount, there's a third-party bank that puts together a finance agreement. Essentially, it's a short-term loan for the association. It says, we'll pay the carrier, you pay us. And they don't do that out of the goodness of their heart. They charge a fee for it. And so you pay them monthly just like you would any other loan. They charge you for it. And so that cost ends up getting snuck in at the very end, where a lot of boards aren't aware. They look at the premium, they see $100,000, then all of a sudden there's a finance agreement that tacks on another $5,000 after that. And so something to be aware of is that when you're working with the non-admitted side, know you're either going to have to pay in full or incur an additional charge for a finance agreement. In years past, before non-admitted carriers became extremely competitive, they were more of a secondary market. You'd end up there when no one else wanted you. They were typically twice as expensive as the standard markets. And so they knew as soon as you went there, your goal was to try to get rid of them as fast as possible. And so you'd go to the non-admitted markets, then your claim would get wrapped up and you'd try to move back to the standard markets immediately. Because of that, they have what's called minimum earned premium. Typically, it's either 25% or 35%, which means you're stuck paying them 25 or 35% of that total premium. If you try to leave a week after you start with them, you're still going to owe 35%. So they essentially handcuff you for 3 or 4 months, depending on the carrier, and you're stuck paying that regardless of if you find a new option or not. Once you get past that 3 or 4 months, they have what's called a short rate penalty. So even if you're at the 6-month mark, they're going to charge you 10% of the remaining premium on your way out the door. So if you're paying $10,000 a month for your policy, you've got 6 months left, that's $60,000, they'll charge you 10% of that. So $6,000 they'll charge you on your way out the door if you cancel and find something better. Something to be aware of when you're signing on that dotted line, you're going to be stuck there for a little bit and there'll be a cancellation penalty if you leave any time within the year. Who currently has a non-admitted carrier for their HOA? Okay, good amount, probably 25%. Of those, how many of you had more than a week to choose before your renewal date? Okay, nobody. So there's always a condensed time frame on the non-admitted side, where typically with our admitted carriers, you'll get 3-4 weeks to choose. With the non-admitted carriers, sometimes you get a week at most, sometimes you get a couple days. We've had some that have come down to the last few hours. And so the non-admitted side works very differently from the admitted. Typically, you got a guy behind a desk picking a number. Instead of, when we work with Travelers, we dump it into their software portal and they have all their actuarial data and it spits out a lovely number at us. With the non-admitted side, these carriers are extremely flexible. So they could be $200,000 or they could be $100,000. It just depends on what that underwriter feels like that day and where they think they can win the business at. And so what they do is you go to 4 or 5 different carriers. They know that the first person to put out a number is typically the first person to lose. So if one says 200,000, that's the first one we use to go negotiate. Then we go to the next one and say, can you beat 200? And they go to 190. And then we take that and go to the next one. And so they know that this is how the game works. And so they all hold it to the very last second. And then they all throw it out with a couple days left. Not a ton of time to negotiate, not a lot of time for us to do our job and go back and try to work with 5 or 6 different ones to drive that price down. They all hold it to the last second, throw it out there. We've got a couple hours a day to negotiate and then get it over to the board or the property management company for you guys to then review with, we're always down to the last few hours. And so unfortunately, that's just how the non-admitted markets have always worked. It's nothing that we can typically speed up. It puts us in a tough spot, puts the board in a tough spot. It puts the unit owners in a tough spot too, especially if you've got certain restrictions where 30 days notice is required on premium increases, or if you're going to special assess for insurance. And so nobody loves this time frame. Unfortunately, it's nothing that we can control. And then last but not least, these non-admitted carriers are typically only a property carrier, where back in the day you may have had American Family. They packaged together your property, your general liability, your crime, your D&O, your umbrella. It was all with one carrier. You got one invoice from American Family. With the non-admitted side, they just write the property. So then we have another carrier that will do the general liability. And then you'll have another one for the crime and the D&O and the umbrella and work comp. And so you might have 5 or 6 different carriers that make up your entire insurance package for the year. So Mark had mentioned looking into the crystal ball. This is always our favorite thing to do, is when associations reach out or management companies reach out and say, what are we going to pay next year? It's hard for us to know what carriers are going to do in July. Obviously, a lot of stuff can change between now and then, but we always get the question. And so here is my best guess that we're seeing so far looking into the magic ball. Standard carriers right now, we're seeing about an average increase of 5 to 15%. If you've been on the board for a long time, this probably looks better to you than it does others. If you're brand new to the board, 5 to 15% is actually a win for us these days. In years past, it's been 30, 40, 50%. So to have some single digit increases or even 15% is a positive thing in this market. For our non-admitted carriers, we're actually seeing decreases. We're seeing anywhere between 10 to 50% on our non-admitted side. And so in years past, the non-admitted side had been double what we're seeing on the admitted. Those carriers are bringing their premiums down on renewal just to be more competitive and try to retain the business. The second half of the slide is something I could probably spend an hour talking about and trying to condense it as much as possible. But we're always asked about how to prepare. What should you do for your upcoming renewal? So our agency typically starts working on things at 120 days out, pulling together all the necessary documents, the loss runs, the financials, looking at what's changed in the industry. Did anything change with the association? Did they get new roofs? Did they update the siding? Anything positive that we can get from the association. We start to pull that together and then start identifying the markets that we're going to work with. Are they too old for this carrier, too big for this carrier? Now that they got new roofs, are they eligible for this carrier? So trying to come up with what options we're going to have. Then we start the quoting process at roughly 90 days out. Now most carriers won't look at things until about the 60-day mark, but we get it into their system, get it on their desk, so when they do start reviewing things, it's ready and waiting for them. If they're missing any documents, they'll let us know, and so by the time they hit that 60-day mark, they've got anything and everything that they need. That's how our office works. Not every office works the same. So when you're coming up on your renewal, my suggestion is to reach out to your current agent at the 120-day mark and ask them what their plan is. If they don't have a plan, you should probably find a new agent. But if they do have a plan, they should be able to tell you all the stuff that I just ran through. Because of your age, your size, your new roof, we think that these 3 carriers are going to be a great option for you. Unfortunately, because of your age, you're not eligible for these 7 carriers or whatever it may be. And so they should be able to tell you, here's what we're going to do. Now, they won't have numbers right away, but they'll be able to tell you, we're going to see how your renewal from Hartford looks, and then we're going to work with Travelers, Liberty, and Honeycomb. If you are satisfied with that answer, great. Let them work on it, let them go through their process, let them come back to you when they have all their options together. If you're not satisfied with that, my suggestion is you go out and find one other agent to work with. I know it sounds counterintuitive to only work with 1 or 2 people, but the insurance industry is different than every other industry in the sense of if you're working on a flooring bid, you go to 3 different companies, you see what their pricing is going to be, you pick the LV flooring, and then see who's got the best price. In the insurance industry, we don't have the luxury to do that. And so our industry, only 1 agent can work with a specific carrier. Everyone else will be blocked out. So if I'm your current agent, You ask us what our plan is, and we're going to go to Travelers, Liberty, and Hallmark. You go to the guy down the street a week later, he tries to go to Travelers, Liberty, and Hallmark. He's going to get a notice that says he's blocked and he can't work with them. Because we don't have a lot of carriers in our HOA space, typically every agent's going to a lot of the same spots. And so what happens then, you get 3 or 4 different agents, they all go to Travelers, they all go to Liberty, and then they come back to the board and they say, hey, we got blocked, but you like me better than the other guy, so why don't you sign this AOR or agent of record form for me? Or I'm your cousin, why don't you help me out? Why don't you sign this form for me? So it ends up creating a nightmare for the property management company and the board when you bring in 3 or 4 different agents, because they all start stepping on each other's toes, and then they start harassing the board of, can you sign this? Can you do this for me? You like me more? You're my cousin? Whatever it is, they always have some sort of reason why you should sign it over to them. If that form does get signed, it essentially takes the work of whatever the current agent is and flips that over to the other agent. So if the agent that started on it spent 30 days, they already worked with Travelers, they got them the approval for the loss runs, they got the quote back, and then the board signs that AOR form, all of that work immediately flips over to the other agent. The other agent doesn't have to do anything, they just take the Travelers quote from where it is, they put their name on it, and they take it and present it to the board. So it creates a lot of adversity between the agents going back and forth, fighting with the board, asking them to sign stuff over. And so my biggest suggestion in the bidding process is for transparency. If you go to your current agent and they say, we're going to go to Travelers, Liberty, and Hallmark, great. You go to the next agent that you want to bring in and say, we got our renewal from Hartford. They're going to work with Travelers, Liberty, and Hallmark. You can work with whoever else you have. And so that way they're not coming back to you and saying, hey, we tried to go to Travelers and we're blocked. Can you sign this form for me? So being transparent in the renewal process will make life so much easier for you guys. It will also make life easier for the agent. It will save them a bunch of time too. They don't have to go quote Travelers and Liberty and Hallmark and wait for a week to hear back just to hear that they're blocked. And so when you're going through the bidding process, just make sure that if you are going to engage another agent, be transparent, let them know who you're working with already, what carriers they're going to go to, and then they can tell you, all right, if we're not going to use these, we're going to use these 3 carriers, and we think we have a good shot with them. And so it will help speed up the process, make life a lot easier for all of you. Evaluating the options once you do get them in is the tricky part. Every agent always has the best quote. If you ask them to compare yours and their own, it's always their own. That's the best one. And so finding an independent source to review those options can be very difficult. Your management company may have somebody on staff that can do it. We've also found that some of the AI tools can be extremely helpful. So ChatGPT and Notebook LM we've used to just dump in the coverage summary that you see, that spreadsheet that you normally get. If you put that into either of those, it can actually generate some pretty decent content telling you some things to look at, like this one doesn't have sewer and drain or doesn't have enough ordinance and law coverage. This one requires payment in full. And so if you're looking for an independent source, ChatGPT and Notebook LM are actually fairly helpful in that process. Again, if your management company may have someone on staff as well, but finding an independent person to compare the quotes is usually very helpful to do. So this is just another page on the broker of record, agent of record form, just so you know exactly what it is. The one other thing I would point out is that not every agent discloses why they're having you sign it. Some will just say, hey, I need you to sign this so we can start quoting on things. Then all of a sudden they take all the quotes that the other agent did. The other agent comes back and asks the board, hey, what are you doing? I thought you liked me. The board goes, I have no idea what you're talking about. And then you find out that you signed a form that you didn't even know what it was, and it transferred all their work to someone else. And so you don't need to sign stuff for a quoting process. So if an agent's asking you to sign something during the quoting process, you might want to double check and see if there's a broker of record or agent of record form in there. So once you get through all that fun stuff and we find 2 or 3 carriers that are actually willing to look at your association, these are the big things that the underwriters actually look at. So we got past the age and size issues. Now first thing they do is look at your claims history. Most carriers require 5 years claims history or loss reports. Some only go back 3 years. But what they're looking for is frequency and severity issues, and if you've been profitable for whatever carriers you've worked with over the last few years. So if you've got frequency issues, if you've got 3 or 4 small claims, they were only 5 or 10,000, but you've had a handful of water claims, Doesn't reflect great on the association. That underwriter's afraid that that next water claim is going to be in the unit that has snowbirds and they're in Arizona for the winter, and now it's a $200,000 water claim. Severity issues are also a big red flag for underwriters. If you've had a large fire, a large sprinkler break, a large wind-hail claim, those also don't reflect great for the association. If you've had frequency and severity issues, it makes our life very difficult to convince the underwriter this is a risk that they want to insure. Asphalt roofs and vulnerable siding types. So although you may fit a carrier's profile from the size, say they want 25 million, you're only at 20 million. So they're interested in writing the association. What a lot of carriers do now is they take an aerial image of the association and then they dump it into a software system that tells them how large your roof footprint is. And so depending on the association, if you've got a slab on grade 1-story home, your roof footprint is larger than the same size square footage if it's a 2-story with a walkout basement. And so there's a handful of carriers that will look at the footprint of your roofs, and if they are too large, they're afraid of a significant hail claim. They may deny offering a quote because your roof footprint is too large. On top of that, they take it one step further. They look at your siding type. So if you've got a large roof footprint as well as vinyl siding, that may be a reason for them to decline, where if you've got that same roof footprint with stucco siding, they would offer a quote. And so internet makes things very easy to jump online and look at the whole portfolio of the association, see the size of the roof, the type of siding they have, and give them another reason to decline. Another show of hands, has anyone not had to deal with grilling issues in their association? All right, few lucky ones. Just talk to your neighbors and see how awful it's going to be when you do have to talk about it. Grilling issues came in the last 2 or 3 years. As carriers had the upper hand in our marketplace, they decided that they didn't like grills any longer. And so in an uncompetitive marketplace, when there's only 3 or 4 carriers, they can pick and choose what they want to do. And what they chose was that they don't like grills. Essentially, they can't see what's going on in your inside your unit. They don't know if you're cooking hibachi every night, but if you have a grill outside on your deck, they can pop on Google Earth and they can see that grill. If they don't want it there, they can tell you to move it. And so over the last few years, almost every standard carrier has rolled out some sort of grilling restriction. Frustrating part of them telling you can't grill is that there's no uniformity. The carriers don't follow the Minnesota guidelines. They don't follow city guidelines. They haven't banded together to create a guideline between all of them. They all make up their own guidelines. So some carriers may not allow grills on decks. Others require grills to be at least 10 feet away. So if you've got a 15-foot deck, you can have it. If you've got an 8-foot deck, you can't. Some allow electric grills like Traegers, some allow charcoal, some don't allow charcoal whatsoever. And so as you're going through the renewal process, know that almost every standard carrier has some sort of grilling restriction. A lot of times it doesn't get brought up front, and all of a sudden you sign up with Travelers, they come out and inspect things and tell you, if you want to keep your policy, you got to ban grills in the next 30 days or we're going to drop you. So knowing that if you're working with a standard carrier, almost all of them have grilling restrictions, make sure to ask about the grilling restrictions because they can be a huge pain for the association. The good news is that because this marketplace is getting more competitive, we've seen most of our non-admitted carriers drop their grilling restrictions. So 2 years ago, they were fine with it. They were banning grills just like everyone else. Now that the marketplace has become more competitive, that's been a competitive advantage for the non-admitted carriers, where if you're looking at a quote, one's $50,000, the other's $50,000, but one you can grill and the other you have to ban grills, most associations are picking the one that allow grills. And so non-admitted carriers have dropped their grilling restrictions in order to be competitive. Honeycomb, Trisura, the new company that came in August, they also have no grilling restrictions either. AmTrust, which is one of our carriers for larger associations, they just dropped their grilling restrictions too. So we're starting to see this shift as the markets become more competitive. Carriers are actually having to be a little bit nicer than they were in the last few years. Then all that to be said, it's difficult to obtain multiple quotes these days. It's easier than it was 3 months ago, but the days of having 4 or 5 different options for your association to review can be very difficult. You look at the size, the age, the roof footprint, if you have grills, and your claims history. when we only have 12, 13, 14 carriers, a lot of those can get eliminated pretty quickly. So I do think that you'll have some additional quotes this year, where in years past you may have just had your renewal. Because the market's getting a little more competitive, you may have 2 or 3 options this year, but the days of having 4 or 5 or 6 options, unfortunately, I think are long gone. There's Fannie, Freddie, and FHA do roughly 80% of all loans in the country. They have a stipulation that says that HOAs cannot have a deductible over 5%. And so this, when it was originally rolled out, was just applied to wind and hail, but it actually applies to every deductible. So when you're going through your renewal, if you're looking at your deductible, we've seen issues where associations have taken wind hail deductibles higher than 5%, or they've done per unit deductibles for something like water damage that end up equating to more than 5%, and then all of a sudden no one can refinance their home, or anyone looking to sell has to sell to a cash buyer. So just something to be aware of when you're going through your renewal process. There is a caveat in the Fannie Freddie language that says your deductible can be higher than 5% if the issue in this area is geographically specific. Unfortunately, no one's been able to convince Fannie and Freddie that hail is geographically specific issue to Minnesota, so for the time being, the exception does not apply. We always get the question, what should we do to make life easier? How do we make our insurance not so painful every year? The first thing you can do is increase deductibles. It moves the needle a little bit, typically not a lot. Depending on your association, you might not have much room to move your deductibles because it may have been forced upon you over the last few years. But the all other peril deductibles, so anything besides wind hail, we typically tell people not to go over $50,000. So most carriers will offer higher than $50,000. They'll gladly give you a $100,000 deductible, but it becomes a problem for your unit owners. Most HO6 policies will not offer more than $50,000 in loss assessment coverage. So the board may think it's a great idea to move to $100,000, save $10,000 on their premium, then you turn around and tell your unit owners and none of them can find proper coverage. So if you're looking at increasing deductibles, I suggest nothing higher than $50,000. And then on the wind hail, if you aren't already at 5%, you can move up to 5%. But again, because of the Fannie and Freddie issues, I wouldn't go higher than the 5%. So the biggest thing the association can do to move the needle on their insurance premium is review their coverage definition. Most townhome associations, or traditionally townhome associations, have covered the interior of their units. So if you have an all-in or an original specifications coverage definition for your association, that means that the association's covering the interior of the units. Depending on your governing documents, you can switch to bare walls. Your governing documents dictate your insurance, and so some of you may be able to easily switch to bare walls with a simple resolution that the board can simply vote on and sign off on. Others, you have to actually go through an amendment process, which typically takes 4 to 6 months. You need to have your attorney involved. Every unit owner needs to vote, and so depending on your association's declarations, this can be an easy or not so easy process. But if you are able to switch your coverage definition to bare walls, this removes the coverage for the interior of the unit from the association's master policy and puts it onto the responsibility of the homeowners. Now, the homeowners have to make sure their HO6 coverage is increased to cover the interior of the homes, but this usually saves 15 to 20% on the master policy. So it can move the needle significantly. I know Mark's talked about it in other HOA meetings. His association moved from all in to bare walls and it saved them $100,000. So something to review. I think. So bare walls just doesn't cover the interior of the units. It stops at the drywall. So the drywall and anything behind it, so the electrical, the HVAC, the plumbing, that's all covered by the master policy. The drywall and one coat of primer paint is what's covered by the HOA, and then the unit owner's policy kicks in from there. So the flooring, the cabinets, the countertops, the fixtures, anything that needs to be put into the unit past the drywall is responsibility of the unit owner. So the windows, the exterior as well. So the windows, doors, garage doors, anything on the outside. So essentially it's just the HOA would cover the entire building up to the drywall, leaving an empty shell of a unit. And so the unit owner just has to finish off that interior portion.